December 2001, America's seventh largest company vanishes overnight. $75 billion in shareholder value gone. 20,000 employees wiped out. But here's the twist. The biggest lie wasn't the collapse. It was what they convinced everyone they actually did for a living. This is the story of Enron, the company that sold nothing, made everything, and fooled absolutely everyone while doing it. Picture this. Houston, 1985. Two boring gas companies merge into one slightly less boring gas company. Think pipes, meters, and the kind of business that puts accountants to sleep. That was Enron, just your average move gas from point A to point B operation that no one outside the energy industry cared about. But then came Kenneth Lay, Harvard MBA, smooth talker, and a man with one revolutionary idea. What if we stopped being a boring utility and became the future instead? Lay's pitch was simple. Deregulation was coming. The government was about to stop telling energy companies what to charge. And when that happened, Enron wouldn't just move gas, they'd trade it, package it, slice it, dice it, and turn it into financial poetry. Enter Jeff Skilling, the McKinsey consultant who looked at spreadsheets like other people look at art. Skilling didn't see Enron as an energy company. He saw it as a technology company that happened to deal in energy. We're not selling gas, he told investors. We're selling the future of commerce itself. And Wall Street ate it up like candy. The real game changer came in the late 90s with Enron Online, a digital marketplace that made energy trading look as simple as ordering pizza. Click a button, move millions of dollars worth of natural gas contracts. Suddenly, boring old Enron wasn't just some Texas pipeline firm, it was Silicon Valley with a cowboy hat. Reporters swooned. Fortune magazine crowned them America's most innovative company 6 years running. Inside Enron's gleaming Houston headquarters, the vibe was electric. Skilling told employees they were the smartest guys in the room. Translation, perform or perish. Bonuses were massive, competition was brutal, and every quarter was a blood sport to impress Wall Street. From the outside, it looked like the future. Glass towers, brilliant minds, revolutionary technology. But ask one simple question, what exactly do they do? And you'd get 40 minutes of buzzwords, a whiteboard covered in arrows, and a migraine. But the stock price kept climbing, so nobody asked twice. By 2000, Enron was unstoppable. The stock rocketed from $7 in 1997 to over $90 by late 2000. That's a 1,200% gain in 3 years. If you bought Enron stock instead of groceries, you were a genius. The media called it a miracle. Executives called it Tuesday. Behind the champagne and PowerPoint presentations, though, something was quietly cracking. See, Enron had made some big promises. Constant growth, explosive profits, no bad quarters, ever. But energy markets don't work like that. They're not social media. They don't go viral every week. So Enron did what any rational company would do when reality doesn't match expectations. They changed reality. Enter mark-to-market accounting, also known as counting chickens that haven't hatched and might not even be chickens. Here's how it worked. Enron signs a 10-year energy contract. Instead of waiting for actual money to trickle in over the decade, they counted all 10 years of projected profits immediately. Right now today, can you do that? Well, Enron was doing it. On paper, it looked like Enron was a cash printing machine. Every deal was a home run. Every quarter was Christmas morning. But dig deeper, and many of those deals were barely profitable. Some hadn't even started. Others were based on projections that made fortune telling look conservative. But as long as the numbers looked good and the stock kept rising, nobody dared peek behind the curtain. And when the math still didn't add up, enter Andy Fastow, Enron's chief financial officer and the master of what we'll politely call creative bookkeeping. Fastow had a solution for every problem Enron faced. Losing money on a deal? No problem. Drowning in debt? Easy fix. Need to make your balance sheet look prettier than a magazine cover? Andy had just the trick. He created dozens of mysterious entities with names like LJM1, LJM2, and Raptor, because nothing says legitimate business like randomly generated acronyms that sound like rejected Star Wars droids. These weren't just companies, they were financial magic tricks. And the greatest illusion was making everyone believe they understood what Enron actually did. Here's how the scam actually worked. Enron would take their worst assets, failing deals, money-losing ventures, toxic waste that was bleeding cash, and sell them to these mysterious entities. On paper, it looked like Enron was cleaning house and bringing in revenue. In reality, Enron was secretly funding both sides of every transaction. It was like selling your broken-down car to your imaginary friend, lending him your credit card to pay for it, then bragging to your spouse about what a great salesman you are. But here's where it gets truly twisted. While Fasto juggled liabilities like a circus performer on fire, Enron's executives were quietly cashing out. Millions in bonuses, stock options by the truckload. Meanwhile, regular Enron employees were being told to pour their retirement savings into company stock. Their 401k plans were basically shrines to Enron. Every Wall Street analyst still gave Enron glowing reviews. Buy ratings across the board. Of course, many of these analysts worked for firms making millions managing Enron's business. Objectivity was optional. Fees were not. The whole system was a house of cards built on a foundation of pure fiction. And everyone was too busy counting money to notice the walls were made of paper. By mid-2001, the cracks were showing. Jeff Skilling, the brilliant mastermind who'd convinced the world that Enron was the future, suddenly resigned as CEO. No scandal, no explanation, just a casual, peace out, I'm done being a genius. That's when people started asking uncomfortable questions, like where was all the actual money? And why did their financial statements look like someone fed them through a paper shredder? Then came the whistleblower. Sharon Watkins, an Enron vice president who'd been watching the numbers dance, sent a memo to Kenneth Lay that should have set off every alarm in Houston. I am incredibly nervous that we will implode in a wave of accounting scandals. Lay's response? Let's work on better messaging. October 2001, the house of cards finally collapsed. Enron admitted to massive accounting errors, corporate speak for "we've been lying about everything for years." $586 million in fake earnings vanished overnight. The stock price went into free fall, plummeting from $90 to pocket change in a matter of weeks. December 2, 2001, Enron filed for bankruptcy. $75 billion in market value, gone. 20,000 jobs eliminated. Retirement accounts that employees had trusted with their futures wiped out. The aftermath was brutal and swift. Arthur Andersen, Enron's accounting firm and supposed financial watchdog, got caught shredding documents by the truckload. They weren't just auditing Enron's books, they were helping write the fiction. The firm collapsed overnight, taking 85,000 jobs with it. Kenneth Lay and Jeff Skilling found themselves in handcuffs, facing decades in prison. Fasto cut a deal and got 6 years. The smartest guys in the room suddenly looked like the most obvious criminals in America. But here's the real tragedy. Enron wasn't just a company that failed, it was a company that succeeded at being something it never was. For 16 years, they convinced the world they were revolutionizing energy, pioneering technology, and printing money. In reality, they were just really good at lying. The Enron scandal changed everything. New laws, new regulations, new rules about who can audit whom and how financial statements must be prepared. But the deeper lesson isn't about accounting standards or corporate governance. It's about what happens when everyone wants to believe in something so badly that they stop asking the most important question of all. What do you actually do? Because sometimes the most dangerous companies aren't the ones that fail at what they do. They're the ones that succeed at convincing everyone they're doing something they're not. And that $75 billion lie, it wasn't just about the money, it was about trust, belief, and the price we pay when brilliant people decide that reality is just another thing to be engineered.